I'm going to give you some rules of thumb on how you can have your diversification strategy or your asset allocation strategy. The first one, and that is how much money do you put in those safe bets or those low risk assets. My rule of thumb is that you put your age as a percentage of your total net worth into those safe bets or those low risk assets. The second rule of thumb is that how much money out of that safe bets or the low risk assets should you have in form of liquidity, and that's your emergency fund. And the simple rule of thumb that I would recommend for you to do is 24 minus the years to your target retirement age, and that is the number of months that you should have your emergency fund, with a minimum being 6 months at least. The third rule of thumb over there would be that minimum out of that 50% should be in either of exchange traded funds, mutual funds, index funds. The fourth is linked to that is, yes, you may own individual stocks, but in that risky part, you should not have more than 10% of your total investment in one particular stock. So let's say you're 20 years old, and that means you put 20% by that rule of thumb into those safe bets. And out of that 20%, you have 6 months of an emergency fund in form of cash or in short-term fixed deposits. The rest 80% is in those riskier assets. And over there, out of that 80%, the 50% of that should be in, at least a 50% of that should be in ETFs, in mutual funds, and the rest remaining 40%, you should not have more than probably 8% in one particular stock. Why? Because you're exposing yourself too much to one particular company. If you do follow this, I think you will have a fairly good distributed asset allocation strategy, and you will be fairly well diversified.